Welcome. I'm Courtney Carr, the Director of Marketing and Education for CAPSA. Thank you for joining today's CAPSA Annual Economic Forecast webinar presented by Catherine Putney from ITR Economics. Catherine specializes in applied research for business cycle trend analysis, growth cycle trend analysis, and implementing cyclical analysis at the practical company level. She holds a master's degree in economics from the University of New Hampshire. Catherine regularly contributes articles to ITR Economics' flagship publication, the ITR Trends Report, focusing on the manufacturing sector of the U.S. economy. Catherine and the ITR team have put this expertise to work for companies across a wide range of industries, including manufacturing, chemicals, fiber, healthcare, distribution, real estate, construction, and technology. As a reminder, during the presentation, you may submit questions into the tab on your webinar toolbar, and we will answer them at the conclusion of the presentation. Following this webinar, you will receive a link to a survey. Once you've completed a survey, it will say thank you, and there will be a link to download the presentation slides. You will also receive a recording of today's webinar. Please feel free to share the recording and slides with others in your office. With that, I would now like to turn the presentation over to Catherine.
Thank you, Courtney, and thank you everyone else for logging in today to view the webinar with our economic update. I'm very excited to talk about kind of what's been going on with the economy in the past 6 months since we've last had our last webinar review. So feel free to chime in with any questions you have as we go through today's presentation. I'll be happy to answer them at the end of this webinar. Now, that being said, I kind of want to give a lay of the land of what we're going to be walking through today. The first part is going to be more of a macroeconomic outlook, similar to last time around if you were attending last time. We're going to look at the 50,000-foot overview of where the economy stands. Then we're going to hone in a little bit more on where your actual markets are and what it means to your business. Because at the end of the day, I can give you all of this economic information. I can dump this data on you all day, every day. But the really meaningful part of it is, what does this economic information mean for my business? How can I utilize this information and what's going on in the economy to be above my competitors, to get that competitive advantage, maybe gain market share or do X, Y, Z things in my business, knowing where I am in my business compared to my competitors, which they may not know where the economy is heading. So this is a really great tool for the next hour to utilize in your own business to see, okay, what do I need to be doing? Do I need to be hiring new workers? Do I need to be more risk averse in my process as I go through? So feel free to chime in with your questions. I really wanted this to be a very engaged webinar where you're asking questions, I'm answering questions on your side of things. So the first thing we'll talk about as we're going through today is the road ahead. So it's kind of looking at the macroeconomic outlook. And when we look at the macroeconomy, let's look around the scope of just the U.S. We'll look at the overall population in the world. Now, where the people are, what we can see on this chart here is really looking at Asia and Pacific is the macroeconomic, or they take the largest piece of the pie in terms of where the people are. 55.7% of the global population is in Asia and Pacific. That's the yellow there. Now, North America, that little blue sliver there, I'll use my mouse too to hover over that little piece of the pie there, 4.8%. That's North America. That's not just the U.S. So when you look at the people, really goes to show that Asia and Pacific take over the largest piece of the pie when we look at the people. But the next chart I'm about to show you really goes to say that the U.S. and North America in itself is such a large economic powerhouse, because when you look at this same chart, but not looking at the people, we look at the GDP. So we look at the actual economic size. The United States in general, not even including Canada or Mexico, is 24.2% of global GDP. So we went from this little sliver on the chart, in the pie chart there in the previous slide with the population, to a 24.2%, almost a quarter of the global economy when we look at the purchasing power. So that really goes to show that the U.S. is one of the largest economic powerhouses in the world. And this next chart right here kind of proves that. What it's doing is it's relating every single state in the U.S. to a similar country that has a relative or a similar GDP pattern. So you can see, the size of India is California. Used to be Texas a few quarters ago. Texas was the same size as Canada. Now it's Brazil, which is also a very large country. So we're looking at the sheer purchasing power of the everyday U.S. citizen, and it's moving mountains. The U.S. is the largest economy in the world. It will remain the largest economy in the world for certain reasons, a lot of them including demographic patterns and population patterns. So the U.S. will remain number one for quite some time. This is just a fun little chart I always like to throw into the slides to kind of show the sheer relativity of every single state compared to another country. All right, so let's actually look at the numbers. So a lot of what I've shown so far is just looking at some of these charts here, but let's look at where the U.S. is currently positioned. So honing in on domestic activity. What's the largest barometer that we track in the United States for economic activity? That is, that is GDP. So this chart here is showing GDP through time. The left-hand side, the dark blue there, is looking at historical trends. The teal bars there you can see to the right of the dark blue lines is our outlook. That's our forecast for where we expect the economy to head over the course of roughly the next 3 years. The right-hand side is also doing a similar projection, but it's looking at the growth rates. So it's not looking at the actual level of activity. It's looking at, are we expanding year over year, or are we contracting year over year? Now, the important thing to take away from this chart is on that right-hand side, what you'll notice is that the solid blue line, so this is historical data, so where we are today is the end of this solid blue line, still above zero. We're still growing year over year. In the overall consumer economy. But if you compare it to where we were in the growth period a year and a half ago, we are much higher a year and a half ago than where we are today. So what we call that is the slowing phase. We're actually in a slowdown where we're still growing, we're still doing well, but it's not as great as we were a year and a half to 2 years ago, where the growth rate was hovering around 4%. We're now under 3%, nearing the 2.5% growth rate, and that trend's going to continue. So this is a really key point to take away, because if your business moves with GDP, that means that by the end of the next couple quarters, you're going to be feeling still decent, but not as great as you were a year and a half to 2 years ago. That's very important when making business decisions, because this trend will slow down. And there are other industries as well that we'll get into later today that talk about a more severe of a pull down. So you may be feeling even worse as you head into the next couple quarters. And that is critical when making your business decisions. But the silver lining out of what I'm looking at here is that even at the low point here, that inflection point on the bottom in the early parts of next year, it's just going to hover around the zero line. So we're actually not going to go through a technical recession in the economy as we head into this down cycle before picking back up again. That's good news. That's saying, you know what, I may feel a little bit of some headwinds as we go into the next couple quarters, but at the end of the day, it'll be more of a hiccup. And you want to utilize this time to your advantage. Okay, well, I may feel a slight slowdown in the next couple quarters. Let me utilize that time to train up my staff and train up my workforce to prepare for the growth that we're going to see in the later parts of next year and into 2021. This is the preparation phase that we want to focus on. We want to utilize this information to our advantage. Now, if you operate on a national level, this is a great chart that shows where do I want to be focusing my marketing and my sales efforts. So what this is looking at is a migration pattern. The bluer the states that you see there, that means people are moving to those states. The more salmon or orange color states indicates that people are actually moving out of those areas. So when people are moving into those bluer states, that means that there's going to be more demand for consumption activity, more demand in general for infrastructure and business. That's going to be organically natural opportunities for your business to take advantage of compared to the more salmon color states, meaning there's people moving out. And if people are moving out, that means there's less people there to actually focus on or drive and stimulate the economy in that particular state. So focusing on those bluer states, the Northwest regions, the Texas, and Southeast, I would take with a grain of salt just because there's a lot of baby boomers moving down there after they retire, so their purchasing power isn't as great because they're not spending as much as a typical, let's say, millennial, which is moving to the Northwest. So Southeast still opportunistic, but not as great as, let's say, the Northwest and Texas areas in the states surrounding California. All right. Moving on. Now that we're approaching this, election cycle in 2020, we've had a lot of questions on our end about what's going on with the state of the economy and does a political cycle impact the economy? Now, here at ITR, we very much advocate that we certainly look at policy, but we don't look at red or blue. And this is a chart that explains that. So what this is looking at is the white line is GDP historically, and it's overlaid on top of whether or not there was a Republican or Democrat in the House at the time. And what we looked at after running the numbers was there was no significant correlation between the economy and red or blue. We look at policy, we don't look at politics. And this is kind of dispelling that myth. And Warren Buffett said it best, red or blue, you can still make green. And that's what we're looking at here, is the state of the economy, how we utilize what we're seeing in the economy to our advantage for your business in itself to come out on top. You're going to be that little sliver of the pie that beats the market, utilizing the information that we're providing today. So, we saw it with the tax reform in the last political cycle where, there was a little bit of an extra boost for a quarter or two in B2B spending, capital equipment expenditures. That didn't really move the needle, though, on the overall economy. So what we're looking at here is there is no correlation between whether or not there's a Republican or Democrat as president at the time. We looked more at legislation. We looked more at the policy behind it that would drive that, which typically takes around 18 months to come to fruition. So making a one-to-one comparison would not be accurate in this case. All right. So we talked a lot so far about the overall consumption and the overall consumer trends by looking at GDP data. But given the business that I'm sure you all are related to, it's probably tied more to the industrial side of things. So let's take a look quickly at that trend. Now, this is the next macroeconomic chart that we look at. This is Usd Industrial Production, which is manufacturing, mining, and utilities. Those are the three components of what we're seeing here. Mostly, the bulk of that is manufacturing. Similar to the GDP chart, the left-hand side is looking at historical data, the dark blue, as well as our forecast through time, and we also overlaid our previous forecast against what actually happened. Those similar overlaying charts there you can see, as well as our forecast. And on the right-hand side is our growth and contraction rates for the industrial economy, as well as the forecast in the teal bars there. Now, the difference that we're looking at here compared to GDP is, look at the right-hand side there. The low point, that inflection point on the bottom of the cycle, is below this black zero line, meaning we're actually going to see a technical recession out of the industrial economy compared to the consumer economy. So it all matters if your business is tied, the end consumer is tied to the end user is tied to the consumer, you probably will be feeling less of a burden compared to if your end user is tied to a manufacturing company or a manufacturing plant or the industrial side. because we're expecting a deeper downturn as we head into this year. So know that that's likely going to happen as we head into the next couple quarters. We will feel a low point in mid-2020. That's when you likely will be feeling essentially, I don't want to say your worst, because even at this low point where my mouse is hovering over, it's still the mildest of at least the last three. We can only see two on the chart here, but at least the last three downturns. This is going to be the mildest of them all before things pick back up again. This is a time when this is all the clients that I work with, I talk to them about utilizing this time to your advantage. If you have some freed up space and capacity, if things are starting to feel a slowdown, start training. Start working out a plan to reap the benefits of growth again, because the downturn's not going to be crazy. Try not to cut back on any capacity things or any labor if they're good workers. Utilize the time, the freed up time to your advantage to prepare for the upswing that we're expecting in the second half of 2020 and well into 2021 as well. All right, so we talked a lot about the economy. Let's look at our forecasting method. So we have a forecast that you're seeing right here in front of you where we have an outlook for the future. What's driving? What tells us we're going to see this direction in our forecasting, as well as from the economy perspective, but also from your own business's perspective. You can utilize this and create your own business cycle on the ups and downs in your own data. And that's what brings us into our leading indicators approach. Now, let's pretend that this next chart here, right here, is looking at your own monthly sales data. Now, very volatile to the naked eye. There's a lot of rise and decline going on. Each month is very volatile. It's hard to pick up whether or not the business is in a general rise or general decline. So for this example, let's say it's millions of dollars of sales per month. What we do is we smooth that out slightly into a 3-month moving total. So what this does is it takes the last 3 months of data aggregated together, which is the September, October, and November of 19 monthly sales data, which puts together $5.3 million of sales for the most recent quarter. And I say quarter as in 3 months, not quarter as in 1Q, 2Q, 3Q, 4Q. I say it as in just the last 3 months of data. We recompute this number through time, and what we do is we compare it on a year-over-year basis because that strips out seasonality. If you're a construction company, you're going to see some rising sales figures from December to June just because people do, or businesses often have higher sales figures in the summer months than the winter months. This strips out that to get an actual depiction of where the business is at. So this $5.3 million in November of 2019 is up 10.4% from the $4.8 million of November of 2018's value. Now 10.4%, that's great. That's double-digit growth. But it's all about the trajectory of the actual pattern. So what we do again is we smooth it out even further into an annual trend, a 12-month moving total. So a very similar mathematical process is that what we just saw, but instead of taking the last 3 months, we take the last 12 months of data. So $20.3 million in sales over the course of the last 12 months is up 12.7% from the $18 million in November of 2018. So it's November 19 compared to November 2018. Now, this is a really, really key point to take away here, is looking at the fact that right now we're at 12.7% growth. So if you track this data in your own business and you see 12.7% growth and you're not utilizing the tactics that ITR is providing, it's saying, okay, great, double-digit growth. That's awesome. That's great. Who doesn't want to be in that position? But tracking this data each and every single month will give you a perspective of, okay, well, if I look at my business 2.5 to 3 quarters ago, in April of 2019, I was at 26% growth. That is over sliced in half where we are today. We're at 12.7%. If this trend were to continue from 26 to 20 to 12, this could be in the negative trend within 2 quarters. That's the critical thing to pick up on. And In addition to that, a lot of businesses operate on their top line data. They look at are sales rising or declining. Now, we've seen this transition to decline in the growth rates here on the right-hand side, the column there, for quite some time. But if you look at the top line data, which is the annual 12-month moving total trend in the column to the left, we went from 18 million to 19 million to 20 to 20.2 to 20.3. They're still rising. This and the top line sales numbers are still rising. So that may put a little perspective into place when we're looking at business leaders that are only looking at the top line data, saying, "Oh, things are still rising. Sales are still doing well. They're rising. I'm going to go hire new workers. I'm going to go do all these capital equipment investments, infrastructure projects going on." But that rising trend is likely going to come to a halt soon because I'm seeing the declining trend happening on the column to the right here in the growth rates. Now, this is actually in a slowing position, and that's very reflective in this chart here, which I will go through. I will put all those transitions here. What I like to show here is that the bottom part is looking at your top line sales numbers, and the top part is looking at the growth rate. Now, if I were to draw a line down on each inflection point of the growth rate, you would notice that there's these peaks and these troughs in the growth rates actually happen well before they happen in the top line data, similar to what I was just saying. So I think 2012 is a good example to use in this purpose. If I drew a line down from the peak that happened in the growth rate for 2012 coming out of the Great Recession, I drew a straight line down with my mouse here. That peak happened before a peak ever happened in the top line data where my mouse is hovering over now. This is when you start to say, you know what, I'm going to be more cautious instead of more aggressive. Instead of your competitor that's saying, well, my top line data is still rising. I'm going to go invest. That's not the time to do it because I'm seeing the cautionary signs develop in the rates of change. And the same thing goes for the bottom of the cycle. The next cycle is a great example to use in 2013. We see the low points happening in the rates of change, draw a straight line down, happened before the low point in the top line data ever developed. All right. It's also important to understand your perspective or your positioning in the marketplace because I'm sure a lot of you read the Wall Street Journal and a lot of the media outlets out there, and you see, okay, well, the economy is doing well this month, or certain areas of the economy are doing well. That doesn't mean it has a direct impact on your business at that point in time. What this is telling me is you got to understand your positioning in the cycle. So right now we have the ups and downs of the business cycle here, and you can see all of the areas of the business and where they're positioned. Non-residential construction typically lags the economy, meaning what's happening today in GDP on the news outlets means if you're tied to non-residential construction, you're going to be feeling that, not right now, you're going to be feeling that a year from now, maybe more or less, give or take a couple months here and there. If you're tied to housing, housing is one of the leading front runners on the cycle compared to the overall economy when we look at GDP. Housing's down right now. That's why we expect the overall economy to be down as well. So if you're tied to housing right now, that means that you're likely feeling a little bit of a slowdown or a little bit of contraction because, at least on the single-family side of things, housing's down. So you have all these different industries in certain positions on the cycle because of how upstream or downstream they relate to. So non-residential construction typically lags, so that probably likely ties to the commercial side of things, which a lot of you probably operate in, and we'll get to those trends later as well. But housing is down right now. So it's all about what eggs do I want to put in which baskets. I don't want to focus on housing right now because I know that it is down. It's negative. It's below that zero line. Whereas non-residential construction is up, and it's growing year over year. This is a good market to actually be in right now. Medical also lags as well. So you can see medical and non-res are doing decently well. They're starting to slow down, but they're still going to provide opportunities over the next couple quarters compared to the housing market, which we're seeing down right now. So that gets us more into our forecasting methods. What's also telling us we're going to be heading into a certain direction into the future, it's looking at our leading indicators. Now, what this is showing is in real time, it's looking at the blue line that you're seeing here is the Usd Industrial Production. So this is our macroeconomic barometer for manufacturing activity, and the orange line is our ITR leading indicator. Now, looking at this right now, there's not really a great correlation between the blue and the orange. Those peaks and those troughs, those inflection points, they don't really line up all that well. So what I do, or what we do here at ITR, is we move that orange line. So the orange line has a 12-month lead time to the blue line. So we shift that orange line to the right by 12 months. Now you can see there is a great relationship between that blue and the orange line. And what that does is that creates 12 months of insight, where my mouse is hovering over on the right-hand side, of where the blue line is likely going to go. Because you move the orange line to the right into the future, and that's what creates the best correlation, the best logical relationship as well, that tells us the blue line is likely going to decline more. And that's what drives our forecast. And this is also predicated on the fact that we do have a lot more forecasts that are a lot more leading indicators that tell us that direction. So the blue line with the diamonds there that you're seeing is our industrial production outlook. Now, every single line that's about to pop up, which you already saw the G7 indicator, is our leading indicators for the economy. And they have already been shifted to the right, which is why you can see the end of the solid orange line. If you drew a straight line down, I mean, we're not in 2020 yet, but this tells us what the direction of the blue line is going to go into 2020. So the G7 indicator has been in general decline. The U.S. Purchasing Managers Index is in a general decline. It's kind of formed a little bit of a low point there, which is good news because it would corroborate the low point that we're expecting in the industrial economy. We have the Wilshire market cap. It's a stock market related indicator in decline. We have the JP Morgan indicator also in decline, or general decline. So it's not just one indicator. It's a preponderance of indicator evidence that tells us, you know what, there's nothing here that tells us the economy is going to go into a rising trend. If at all, we're going to see some more decline over the course of the next 1 to 2 quarters, which you should be aware of and conform your marketing and your sales tactics to that, and your planning and your strategies to that type of economic environment. All right. This is a great quote, and I believe I provided this in the last delivery as well for the webinar, but it really is a great quote. It's not enough to do your best. You must know what to do and then do your best. Now, basically, this whole quote is encapsulating the fact that you should know what's going on in the economy and then act on what's going on. So you know that the labor market's tight. Try to keep your labor around. You know that we are heading into a downturn. Maybe start focusing your marketing and your sales toward a more price-sensitive product or service compared to a quality, because as businesses start to pinch their pennies, they may want to go for the cheaper product rather than the high-quality product. So it's being informed of what's happening in the economy compared to just kind of making decisions on a whim. All right. So this is the more unfortunate or pessimistic part of my conversation today, but I think it's very valuable to be aware of. And now it's the prosperity in the age of decline. Brian and Alan Bolio, our president and CEO and president in respective order, wrote a book called Prosperity in the Age of Decline, talking about the 2030 depression. We're pretty much expecting a kind of apocalyptic, fall off a cliff kind of depression in 2030. And the reasons for that are as follows. We have demographic trends. right? So we have 10,000 baby boomers each and every day retiring from now until 2030. That's a huge, huge weight on the shoulders of the U.S. economy when it comes to healthcare costs, which is the number 2 list on that. When the law of economics, it's higher demand for things, the higher the price goes. So we're having all of these elderly individuals starting to get older and require more medical attention, going into an environment where it's going to drive up the cost of healthcare. So we have that. We have those first 2 numbers on this list here checked off on really, I don't want to say it's wreaking havoc on the economy, but it's definitely going to be a burden. And that causes number 4 too. So skipping over number 3 right now, but going into number 4, the inflation aspect. It's going to drive up inflation, especially for the medical industry. Now, number 3 there, the entitlement programs. That's Medicare, Medicaid, Social Security. We have unemployment benefits. Things like that are going to be driving our entitlement programs to go up and up and up. And you'll see a chart in a couple of slides that explains that, and it says, you know what, this mathematically, our debt's going to increase if we don't make any changes to our entitlement programs, or at least our tax receipts. So that all ties into number 5 there, where it's going to only increase our national debt. And a lot of people think, you know what, we're the U.S., we can keep kicking this debt can down the road as long as we want. But at the end of the day, with all of these 5 things and more tacked on, it's going to be the straw on the camel's back in 2030, when that's going to be the end of the baby boomer retirement age, going into the Social Security era. That's going to really hurt the U.S. economy and push us into another depression. And that's what we're looking at in the next 10 years, the next decade. Now, this is what we're looking at here it's not a forecast for the future. This is looking at the 1900s, and when we saw the 1929 Great Depression. So the Roaring 20s, a lot of people think that it was just rise in the 1920s. It actually wasn't. The U.S. actually went through 3 technical recessions in the 20s. The overall theme was ascent, but we actually went through, in the U.S., three recessions. And that's what we're expecting out of the U.S. for the next 10 years, is that, you know what, we will suffer, we will go through some hardships and headwinds in the economy over the next 10 years. The overall theme will be rise. And then 2030 is when we're all going to, go down in the dumps. I like to call it the stairway to heaven for the next 10 years, and then the highway to hell for the following, in the early 30s. So we're going to see that downturn happen in the 2030s, because the U.S. is a very reactionary country. We're not very proactive. If we see something coming, we react to it after it happens. We don't say, let's solve it before it happens. Let's try to prevent it from happening. That doesn't typically happen in the U.S. It's always, we'll figure out a way to recover from it rather than prevent it. And that's what we're going to see over the course of the next 10 years. There could be ways to resolve it. We're very transparent with our information. If something gets introduced that could change our outlook, something gets baked into the mix, yeah, we'll change our outlook. We'll work that in. But at this point, we're not seeing any of that happening. So what we're looking at is this is still going to happen unless anything drastic takes place on Capitol Hill. And this is kind of the reasoning I was talking about earlier. So the blue line is our tax receipts. I want you to focus on the top 2 lines there. The blue line is looking at overall tax receipts. The red line up top is transfer payments. So that's Social Security, Medicare, Medicaid, unemployment benefits, welfare, disability, things like that are all grouped into that red line bucket. Now, if we're not making any changes recently to either increasing our tax receipts, which I don't see happening in the near future, or decreasing that red line, which is our transfer payments, nothing's going to come out about this. We're going to increase our national debt. This blue and red line difference is only increasing our debt, our national debt, more and more and more. So we need to be making fixes to either that red or blue line to try to come back to a more stable, financially stable economy. All right, let's talk a little bit about prices. So prices are often, when we talk about prices, it's often looking at the consumer price index, so inflationary trends, in the producer price index, meaning as a business leader, what type of pricing pressures am I feeling internally in a business standpoint. Now, a lot of that has to do with the interest rate that's at the time. So what we're looking at here is the red line is, I'm sure some of you have seen this chart before, but the red line is looking at our overall interest rate historical trend, and it just so happens that it has a 100% correlation, I don't want to say 100%, but very good correlation to the height of the Federal Reserve Chairman at the time. So we have Volcker, Greenspan, Bernanke, Yellen, all shorter than their predecessor, and then Jay Powell had to come and ruin it for all of us, and basically ruin the correlation trend that's going on here. So we don't expect interest rates to really rise aggressively. If at anything, pretty much tracking flat in the near future. But in reality, let's look at some of the consumer and producer price trends. What we're seeing here is the orange line, which is the pricing pressures that you and me every day go out, the type of pricing pressures we feel on the retail side of things, versus the blue line, which is, as a business leader, how are my costs of doing business, or what is my cost of doing business? And I believe when I was talking back in April for this the previous webinar, you would have heard me say, you got to be raising your prices. Because back in April, or even before that, the blue line was well above the orange line, meaning if you weren't raising your prices, your margins are being eaten away. Now we're in a different position. We're in a position where the input cost, the cost of doing business, is actually growing at a less severe pace than the cost that we're passing on to the consumer. So this means you can actually reap some benefits out of this situation. If you keep your input costs flat and you raise your prices onto your consumers, you could gain some margin because of the fact that we're seeing prices passed on to the consumer at a much higher rate than the price growth, the input cost growth on the producer side of things. So you utilize this information to your advantage. You can really gain some market share if you want to focus on gaining that market share and gaining margin. But let's look at some of your own particular segments of what you do in your own business. Let's look at commodity prices. Now, all are down. I mean, if we talked a year and a half, 2 years ago, it would be an extremely different situation. We're now in the market or in the situation where all of these are negative. Copper, zinc, aluminum, steel, all in that negative trajectory. Because China, Western Europe, Eastern Europe, Canada, the U.S. are all in a slowdown in the economy, meaning declining demand is going to drive down the pricing pressures, even with the tariffs that are happening right now. And we always like to call copper, we always like to say copper has its PhD in economics, because copper is so widely used in every single industry that the trends in the pricing environment of copper pick up where the economy is going to head. So what we're seeing here is the orange line, which happens to be similar to the color of copper, is down right now almost 8% year over year. And then the blue line is B2B expenditures, so investment activity in the U.S. We're seeing a little bit of a plateau happening in copper prices, but it's still negative, meaning there's declining demand in the overall globe, not just the U.S. This is a global indicator that we look at, meaning we're going to see some more decline from the blue line, but it might start to plateau soon, which is very much in line with our forecast that over the course of the next 2 to 3 quarters, we're going to see that low develop. So knowing that the next 2 to 3 quarters will be a slowdown followed by that uptick is really, really crucial. This is a fun chart that I always like to show too, is looking at business optimism. Because if your business is less optimistic, you're probably not going to go and make those aggressive expenditures, aggressive plans or projects to spend on. And so this really portends a lot of the trends that we're expecting in the economy, where that blue line is looking at business optimism. Look at that spike down recently. Businesses are becoming less and less optimistic. They're becoming more risk-averse and more pessimistic. And the orange line is looking at how much businesses are spending. That's also in the decline. And historically, that's an impeccable relationship between the blue and the orange line. They're not on top of each other, but directionally speaking, still really, really great. So we're expecting some more decline to happen out of this orange line, which is the B2B activity, meaning you're probably going to face some headwinds moving into the future. All right, kind of shifting gears here. This is a chart I would like to show just to kind of discuss what industries I think are doing better than others. This is delinquency rates on loans for certain industries. Now, the blue and the green line, I'm fine with. The mortgage, the housing market, and the student loan market, I think that's in a good position. It's the auto market. Now, it may not, depending on if your business is tied directly to auto or not, or somewhat tied to auto, this may be relevant. If not, personally too, on the personal side of things, there's a lot of risky lending going on in the auto market right now. We're seeing this 10-year average, which the green line is right on top of the pink line, so you can't really see the pink line 10-year average, but it is at the green line. So the auto delinquency rates are actually above its 10-year average. We're seeing you can get a 7-year car loan. Retail sales are down. Inventories are building up in this industry. So I think there may be some risky lending, and I've been watching this industry for quite a bit, for at least the last 2 years, and I've been seeing these trends develop that kind of scare me. I would definitely tiptoe around this industry and make sure that you're covering your bases if you're operating in the auto industry, because I think there is a lot of risky lending practices that could potentially, I don't want to say it is creating a bubble, but potentially be creating a bubble in the auto market like we saw 10 years ago in the housing market. Not similar in amplitude, but similar in the sense that there is that risky lending going on. All right, quickly talking about tariffs. Let's look at the fact that, with the whole tariff thing, who's suffering more, who's suffering longer. What we're looking at here is, and in my mind, China is suffering more. So we're looking at the orange line, which is exports to China. So what U.S. exports to China, meaning what is China demanding from the U.S.? That has fallen much steeper than the blue line, which is our imports from China. If you drew a horizontal line of where the trend is between the orange and the blue line, the orange line, which is China's demand from products from us, from the U.S., I don't want to say us, from the U.S., is at over a 9-year low. Whereas if you drew a solid horizontal line from the blue point, which is our imports, we're still doing well. Yes, we have fallen in a little bit recently because of the tariffs, but we're still at a really, really great point, or I don't want to say great point, but a really decent level compared to the level that the orange line's at, if you drew it relatively to its historical trend. China's a very prideful nation. They're willing to suffer longer and harder, where the U.S. is not in that case. All right, so let's look at some market trends. Let's look at some things that are going on in the marketplace that are going to be advantageous in the future. Let's look at some places or areas of the economy that may not be the case. The first one chart I like to show is looking at just Billings Indexes. Now, everything that's below 50 indicates contraction from the previous month. Everything above 50 indicates expansion. So we're seeing the the Northeast, the commercial section of the Architecture Billings Index, Midwest. Those are all down right now, compared to the upper end of things where we see the South is doing really well. Focus your eggs on these certain sectors, and you'll get this PowerPoint sent to you so you can utilize this even deeper, focus on those areas that are above 50. So everything from the west to the Architectural Inquiries Index, put your eggs in that basket because that's where the opportunities are compared to, the Northeast isn't showing it's doing so hot right now. Focus away from those and into those higher 50 areas. Housing. So you saw earlier I talked about housing being on the front end of this business cycle, and it is down right now. And this is, I believe, the first time we're going to see this type of chart. So I will take a step back just to explain this. The top part here is the business cycle. It's the growth rates and contraction rates of single unit housing starts, which I like to call just the single family, the housing market. The bottom part there is what you saw on the left-hand side of the earlier parts of the presentation. It's just not filled in underneath it. So it's looking at over the course of the last 12 months, where is this industry? We can see 866,000 units over the course of the last 12 months have been started in the single-family side of things. This is what this is showing. So we're at a negative standpoint on a year-over-year basis up top here, negative 2.6, but the quarterly growth is actually up 4.2%. And this also confirms the fact that we will see an upswing as we head into next year for the macroeconomy. So knowing that, yes, things are still kind of plateaued down in the housing market, it will get better. So if your end user or your end customer or downstream is tied to the housing market, right now the housing market's down, but it won't last that way. We're going to see the next year or so, it's going to start to pick up. So knowing that is going to be crucial. Non-residential construction is also huge. I'm sure all the businesses that you operate in are essential in the non-res side. And that's what we're looking at here. We also have a forecast, which you can see, the lower and the upper bound of our forecast for non-residential construction. That's the dots there. Now, the green line is our ITR leading indicator, which leads by 20 months, over a year and a half of leading indicator insight. So this has already been shifted, this green line to the right, to accommodate for that lead time relationship. So what we're seeing here is a general descent going on in non-residential construction. It won't be a severe negativity, but we're back on our feet again, as confirmed by the green line, the ITR leading indicator. So know that the next couple quarters will be pretty much just kind of a hiccup in an overall trend. It's not going to be aggressive. We're going to see some growth again. So know that over the course of the next 2 years, things will still be decent. It won't be until 2022 where you start to feel that negativity if you're tied to non-res. All right, HVAC. So anyone tied to refrigeration and HVAC equipment, which pretty much is also tied very much to just general trends in the macroeconomy, because HVAC is used in so many different realms, so many different markets. The orange line is HVAC equipment production. It's down right now. Usd Industrial Production is the blue line, which we have a forecast for, expected to go more negative. So know that the next couple quarters, I feel like I'm repeating myself a lot, but that's actually a good thing if you feel like I'm repeating myself, because it means that all the markets are trending in the direction that we expect it to. So know that those next couple quarters will be more of a hindrance if your business moves directly with the markets that we're showing today. So definitely down on the HVAC side of things. We do expect that to continue for a couple more quarters before things pick back up again. But at the end of the day, the downturn, it won't be severe. It will be mild. It will be manageable. That takes us into machinery new orders. So anything your business is tied to in the machinery realm, we're seeing some basically stagnant growth. So the green line up top here, 0.8%, where my mouse is hovering over, 0.8% growth, next to nothing. We expect more general decline to happen. It's at a decent level right now over the course of the last 12 months, is $393 billion industry. Expect more decline to happen from this market. Again, another indicator I don't want to make it redundant, but it's just another factor contributing to the expectation for more decline. Electrical equipment new orders, very similar, where we're seeing the overall electrical equipment industry still above zero, still growing year over year up top here, but in a general descent. So the growth isn't, you don't think you're going to see the same opportunities that you saw a year ago when the growth was much higher than where we're at today. Expect that slowdown to happen. Engine, turbines, generators, and other power generation equipment new orders. Again, another trend, really in that slowdown. It's still positive, but again, slowing down. So just know that, very similar to last time around, I'm sorry about that, we're going to see some more slowing activity in the next 2 quarters. And a big driver to that too, is looking at utilization rates. So what we're looking at here is U.S. electric power generation production against the green line. That was the blue line I mentioned. The green line is utilities capacity utilization rate. So the green line is essentially tracking how busy is the machinery in the utilities market. So are we at 50% capacity? We're only utilizing our machinery at 50%. Are we at 60%? Are we at 75%? 100%? Which 100% typically doesn't come around that often. But what we're seeing is the green line, which is more to the right, the lead time, is down. So we're seeing more declining activity from utilization rates, meaning businesses that are in this utilities market aren't as busy as they used to be, which is requiring less production activity, which means that there's less opportunities in the overall power generation market. Kind of a random little industry that I typically like to work in a lot, just to see, if you have the potential to enter into this market, I think it's great, because what we're looking at here is the public water and sewer facilities construction market. I mean, this thing has grown immensely on a quarterly basis, up 15% quarter over quarter from the same time last year. And we're seeing some strong growth trends happening in the data points. Bottom part here, this is a good industry to be in. And this also is reflective in the next one. U.S. state and local government sewer and water line construction, up 20.5%. quarter over quarter. This means that in the next couple of quarters, you're probably going to see there's probably going to be a lot of great opportunities coming from this market in the next few months to a few quarters. This is an industry that I want you to focus on compared to, let's say, the HVAC side or non-res side, which may see some downturn in the next couple of quarters. And that's the whole point of this webinar today, is to make sure that I want to be putting my eggs in the proper baskets. I want to make sure that I'm dedicating my resources to the industries that are actually going to be organic growth opportunities compared to the industries that I'm going to be trying to be aggressive in, but they're not going to give me a whole lot. This is one that may provide you some really, really great opportunities, so focus on those. Oil and gas extraction. I would caveat this. What we're seeing here is a lot of good growth coming from oil and gas extraction right now. However, I would caveat that with the fact that there's a lot of, I don't want to say it's sharing tools, but a lot of the new business opportunities aren't directly tied to how much oil is being extracted, because we've been seeing a lot of the actual infrastructure that's being used to extract the oil being shared across the board for oil rigs. So just know that there is a lot of activity in at least the U.S. going on with oil and gas extraction, but it may be starting to be shared across the board. Electrical equipment right now is doing well. It's up, so this is another good industry, but I would, again, do another kind of caveat here, is that if you compare the industry where it is now at the bottom part here, 89.1, to the historical norm, it's rising, but it's not even close to where it once was. So just understand that, yes, there will likely be new opportunities, but it's not going to be even close to where the overall average was. Civilian aircraft equipment, I know I've been kind of going through this, but this is the last industry I want to talk about before we close up shop here. Civilian aircraft equipment right now is doing well. Similar to the previous chart, if you look at the overall level, it's not where it once was, but it's creeping back up there. So this is a good market to be in. People are traveling a lot, civilian aircraft equipment. Even with the the new regulations that are going on in the overall industry, we saw a lot of those random plane crashes, unfortunately. But that also drives in higher regulations, which may mean higher demand for new planes to come about. So that could be an opportunity that we're seeing develop in the data here in the near future. So this is an industry I would put your eggs in that basket, similar to the state and local sewer and water line construction, and away from maybe the non-res side of things for maybe a couple quarters to focus on. All right, so in summary, what we went through a lot today. So I'll look at the overall trend and look at what's going on in the overall economy, but what we're seeing is 2019 slowing growth. So still, if you move well with the economy, still expect growth this year, but just not at the level that you saw maybe last year. 2020, we're expecting that one half of early next year low point in the business cycle. 2021 will be a good year. Utilize the low point, utilize the slowdown over the course of the next few quarters to your advantage. Focus on training. Focus on the things that you need to be taken care of in your business, if you have any of them, in the course of the next couple of quarters. Because after that, you're going to be focusing on, okay, well, we need to worry about capacity constraints, because you're probably going to see a lot of activity come back online in 2021. So focus on and utilize the time to your advantage while you have it in the next couple of quarters. 2020, backside of the business cycle again. So 2021, second half into early part of 2022, good things happening. 2022, we will be on the backside of the business cycle. All right. So ITR offers a 90-day trial offer. I'm not sure if you're subscribed to it, but it's a free 3 months of our trends report. It's a great read through every single month. We update that. So if you're interested in subscribing, we have 4 different markets that we track: manufacturing, construction, global, and the retail sector. So if you want to look at that, just text TR trial to that number. We'll be happy to subscribe you to that. And I would like to open up the floor now. I know that we have a few minutes left to any questions that you may have had brought in. Courtney, I'm not sure if anyone submitted any questions, but feel free, even right now or after the fact, if anything comes up, don't hesitate to reach out to Courtney or myself to answer any of the questions that may populate about the economy.
Thank you, Catherine. As a reminder, please submit any questions using your webinar toolbar. And Catherine, during the presentation, we did have a question come in right around the beginning. It was on the slide that was depicting the United States of America and different countries within it. And you had mentioned that I believe last year Canada was in Texas, I think, and this year had been replaced. And one of the questions was, where did Canada go according to that chart? Or does it fit in there at all?
Yeah, so California and Texas are the 2 largest states in the U.S. economy, and Canada actually grew to the size that it was no longer relative to a state. So Canada was kind of put out of the group where it could be relative to a state. So it was just too big to relate. But it's similar to Texas, give or take some numbers there.
Okay, and then the next question, and I'm not sure if what slide in particular it was referring to, but in your presentation, was most of your data presented in dollars?
That's a great question, yeah, because I think that's an important statement to make too, because it's in different denominations. So a lot of it, if it has the word new orders at the end, if it has wholesale trade, it's measured in dollars. GDP is also measured in dollars. But if you look at it in a production standpoint, which a lot of the data is also from, production is just looking at volume. So it depends if it's from the Federal Reserve Board, the FRB, then it's measured in units, or I don't want to say units, but volume activity. But if it's from the Census Bureau, which is more of the new orders or wholesale trade side of things, then it's measured in dollars, which would certainly have an impact if we're looking at those trends accordingly, because I believe we did look at two different indicators that were similar in nature but measured differently. There was for this example, we look at the HVAC, refrigeration and HVAC industry. Production right now is actually down, but new orders, which is dollar denominated, is actually up because of the inflation aspect of it. So you're very correct in saying that it's important to look at what we're measuring the data in, whereas the HVAC industry is technically down right now volume-wise, but numerically on the dollar side of things, it's up just because the cost or the price of it is up.
Okay, I had a clarification to that. The follow-up was there was a slide on service center sales, the slide where you explained how the 3-month running average worked.
Mm-hmm.
Would that be in dollars?
It depends what data we're looking at. For the 3-month moving total, we do this. It's the same approach there's two different approaches. We typically do for the volume activity, we do an average. For the dollar, we do a total. So if we're looking at, let's say, your company in dollars, we're looking at the last 3 months of data in the dollar-denominated series, or the last 3 months of sales. If we're looking at your company's data in the last 3 months of units, which does not measure in dollars, we're looking at the last 3 months of units, we typically do an average instead of a total.
Perfect. That answered the question. Thank you so much. So that wraps up our question portion. As she mentioned, if you have any questions after the webinar, please feel free to email Catherine or myself. This concludes our presentation. As a reminder, you will receive a survey about today's presentation. Once you complete the survey, there will be a link to download the presentation slides. In a separate email, you will also receive a recording of today's presentation. Thank you so much. Have a great rest of your day.